From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Hello and welcome to the COB. The day in news and markets. Sorry, the framing is just a little bit off here. It's just one of those situations, I guess. Maybe we'll have to cozy up, or maybe you have to cozy in my direction, maybe like this. Anyway, the COB, your day in business and markets. My name's Kyle Roddo with Danny Akuye, and Danny, not much of a lead overnight. So, well, I guess we were kind of waffling along for a lot of the session.
Yeah, it looks like we're down. Well, I've got 0.2% on the ASX 200, or 0.14%. Communication services, that was green on screen. In terms of, we've had quite positive moves in Telstra, REA, car sales, TPG. A little bit of love for the material stocks off the back of those higher iron ore prices. But yes, very lackluster, very low volumes.
Yeah, indeed. And the CBO 200, let's see if we can get a little bit of a check as to what it was doing there. It was, well, more or less flat for the session. I think maybe even finished slightly lower. We're going to have to probably push on there because it doesn't look like we have the graphic. But there we go, off by 0.24% by the end of the session. But moving on, we'll check in on that again in a little while's time. That's not going to move, but the ASX 200 potentially will, which is down 0.14% today. Three themes though.
Yes, three themes.
Well, I thought the biggest one is that, well, maybe the honeymoon period is over. We saw Robert Scott talking about that at, oh, there you go.
Absolutely.
Talking about that at the Wesfarmers strategy day today, in fact. And, well, I mean, I guess his message was that after 2 or 3 really fantastic years for the economy, for the consumer, he's seeing signs that, well, things mightn't be so great going forward.
Yeah, absolutely. So their business model is really highly exposed to the Australian consumer across many, many broad sectors. He made a point of saying they hadn't pushed through lots of price rises when they could have, because they wanted to still provide a value proposition to the consumer, and they are seeing people trading down. And I think on the back of Universal Stores and everything that we're hearing about retail, my little anecdotal evidence of what was happening in Westfield Bondi Junction, lots of stores seem to be being shuttered at the moment up there. So maybe the consumer is finally cracking. Yeah,
indeed. And well, the honeymoon's over. Sticky inflation, our focus is going to go back to that CPI release, the monthly number that we'll get tomorrow. And well, I thought let the week begin, because we had 2 public holidays, like I said before, in Europe and in the United States as well. Memorial Day kind of meant that we did have that kind of lackluster direction this morning. So we'll get a little bit more information from the markets tonight, especially as it relates to more or less a reaction to that debt ceiling development. But I wanted to talk about some of the corporate news today because, well, we did have Wesfarmers, and, well, I mean, I didn't see the particulars really, but I mean, quite naturally, Rob Scott was talking about the business's prospects. The shares were higher today. Yes,
absolutely. They were outlining, I believe, a lot of their spending programs. He also said that they're not going to chase that silk laser bid, which I think is very interesting. And I just think that he really said the company is well positioned to ride out this slowdown at the moment.
Indeed. And well, another couple of stories that really caught my eye as well was Sayona Mining, institutional placement.
Yeah.
Just relevant because it was just a really big sell-off today in that stock. So
it was quite a discount.
Yeah,
at 18
it was 18 cents and, well,
$200 million, pretty chunky amount.
Yeah. So the stock was pulled back towards that 18-cent mark. Let's as well talk Paladin, because it was another that was, well, I suppose in the news, and it kind of caught a lot of us by surprise early on in the day, but it would seem that Namibia is looking to nationalise some of its mining assets. Paladin gets caught in that, and well, investors hit the sell button, and well, that's over the year, 32%. But for the day, it was around almost 20%.
Correct, and they suspended trading in the stock. But yes, it does look like geopolitical risks, particularly in some of, I don't know whether we term them emerging economies, are rising, with governments really wanting to get a piece of the action, and that's certainly what spooked investors for Paladin, because Namibia is one of the world's largest, not only uranium producers, but diamond producers as well.
Yeah, okay. So we'll keep an eye on that story as it unfolds, because I'm sure uranium Twitter is alight. They can be a pretty eccentric bunch it has to be said, and they tend to like Paladin as well. But another company that's had a, investor day today was Challenger. It happened to be our stock of the day as well. Okay. So we had Scott Phillips from Motley Fool and Luke Winchester from Merriweather Capital giving us their views on Challenger.
The market was made for Challenger. It's just never been able to really get out of its own way. It keeps tripping over its own feet. 13 times earnings, not particularly expensive. I mean, in a financial space, nor is it particularly cheap. But it's one that, as I said, should be able to do better than it is. Sometimes you just find those businesses that just simply, despite the fact the macro should suit them, don't seem to be able to really grasp it. That's Challenger for me. I don't know I'd rush out to sell it at the current price. It's not particularly expensive. 3.9% dividend yield, 13 times earnings. It's pretty run-of-the-mill. If you own it as part of a diversified income portfolio or something, I can kind of understand it. But I wouldn't rush to buy it either.
So look, for me, I actually agree with Scott's conclusion. I don't think it's a fantastic business. It is pretty safe. It's pretty defensive. And admittedly, fair play to management. It's not what I looked at in a while. If there was one thing I would have thought that would potentially be a huge headwind to a business like Challenger, it's rapidly rising bond yields. And they've actually weathered the last couple of years pretty well and look like that's stabilising coming out the other side. So you're not paying a huge valuation, decent little dividend. I'd be happy for people to hold it.
Okay, it's a little lukewarm there, I suppose, but a hold there from Luke, and I suppose Scott was a little bit more mixed on it as well, but perhaps overall a company with reasonable prospects.
Absolutely. I mean, that whole annuity story really comes to life when interest rate raises, come through, because they really, really struggled when rates were at zero. So if it was a time for this stock to perform, now is surely it.
Indeed. Okay, well, let's get to our guest for the show now, and patiently standing by has been Martin Craig from Shaw & Partners. Martin, thank you so much for your time.
Always good to be here.
Yes. Well, it is good to have you. I mean, it's sort of a bit of a rudderless market at the moment because we have had those public holidays overseas. But I mean, what's the setup for this week? Is it sort of debt ceiling relief? Are we going back to worrying about inflation now and rate hikes? What's the story?
Yeah, it's difficult to understand how much of a risk premium was factored in for the debt ceiling hitting the state without a resolution. I read a few research reports that said it is really financial Armageddon if it happens. The government can't actually pay anybody or pay any bills or anything. The economy just grinds to a halt, and it's horrible. So we've avoided that. The credit default swaps on 1 year US debt were up to about 1.7. On Friday, they dropped down to 1.4. They're not trading at the moment. The mini futures are trading, and they're pretty much the same level that they've been all weekend. So it doesn't look like people have put on extra longs in the mini futures, which you would expect. And the performance of the European markets was pretty yuck as well, right? So very technical term, that one. So yeah, your question, what do we focus on now? So assuming this thing goes through Congress and we don't hit the X date, and even if we do, as long as it goes through Congress, we're happy days, we can then focus on what's next. And let's go back to the narrative of the Fed and the next Fed meeting, the next RBA meeting. We've got Governor Lowe, we've got the Reichsbank governor speaking this week, so we've got more central banks speak, and inflation is just too stubborn, right? Inflation is just too stubborn. Central banks have to go again, and then we're starting to see, as you were talking earlier, about the cliff. We're starting to see the cliff. Like this month, next month, and July, 18% of the fixed rate mortgages roll off in Australia. So all these people have known Armageddon is coming, and maybe they've prepared, but I think the banks have run through their buffers. I think the pinch is going to really come in the next 3 months to the consumer. So we're going to have this stagflation thing again, which is not good for markets. So I think markets are looking into the teeth of that at the moment.
Yeah, it's not a pretty picture, is it? Do you put much store in some of the narrative or the commentary about the Treasury having to refill their coffers and raising about $1 trillion or up to $1 trillion US in the Treasury bill market, and therefore you're seeing potentially quite a substantial liquidity withdrawal?
Yeah, two great sucking sounds. One being the flight out of bank deposits into money market mutual funds. That's $1 trillion so far. The next big sucking sound is the Fed, as you said, having to issue short-term paper to pay bills because the government's still running a massive deficit, and that just drains more liquidity out of the market. So you've got two big vacuum cleaners sucking all the liquidity out of the market. And so the banking system has to adjust to that by reducing its balance sheet. So the Fed's kind of said, well, you can swap longer term liabilities for short term liabilities via the Fed window. You can do that, but that's sort of circulating money in a kind of a little bit of bizarre way. It's just going to keep credit tight, which is probably not a good setup for markets either, right?
We're looking into the teeth as well now of a potential rate hike from the Fed in a couple of weeks' time. I mean, that's a pretty remarkable shift probably in the space of a week and a half, where everyone seemed to be pretty happy to price in a hold with now 2 CPI prints globally, especially that PCE deflator, suggesting all this stickiness. I mean, the market's maybe underappreciating that risk for the time being.
Yeah, I mean, Jerome Powell did hint at a pause the last time he spoke publicly. It does seem to be from the minutes, certainly the minutes of the RBA, but increasingly the minutes of the Fed, that it's become a divided issue. One of the great features of the Fed and compared to the RBA is that you know how people vote, and they typically vote unanimously. There was a long time where there was one person who stood out, but typically they move as a group, and they are all central bankers themselves. They're all governors of other Feds, whereas our central bank board, as borne out by the inquiry, they're not central bankers. There's a couple of bureaucrats and then some people from broad backgrounds, but they're not bankers, and they are very mixed on their views. So I think the last sort of knowledge we got from Governor Lowe and how people voted the last 2 meetings was a line ball each time. So I think it's probably unfair to say we're pricing in another hike. We're probably pricing in a 50% chance of another hike. We're getting towards the end, Kyle. That's the important thing, but we're not there yet.
Yeah, and we had those building approvals figures out today, which are very, very downbeat, to put it mildly.
Yeah.
And maybe you can comment those, but also too the problems it's setting up down the track with all this immigration, and then we've got a shortage on building. I mean, it's almost like we're compounding one problem with another problem.
Yeah, I heard you talking to your previous guest about this as well. So housing starts have fallen about 30% from their peak. In really, really bad markets, they fall 40, maybe even 50%. So we're a long way through the big decline. And as you said, we've got to find homes for 1.5 million people. So assuming they all come and not in families, that's 1.5 million dwellings. If they come in a family of 3, it's still 500,000 dwellings we've got to find. We're building around about 100,000 new homes at the moment. So the numbers just don't add up. And the rental market, as we know, is incredibly tight. Rents are up, according to SQM, from $600 for a house a week in Sydney to $1,000 a house in Sydney in the last 2 years. That's a 50% increase in rent. And my son and his fiance just got a letter from their landlord, 25% increase in their rental bill. So it's happening right across the industry because the returns just aren't there. If you've got to go and borrow money, Danny, and pay 6% to build a new apartment or something like that, you've got to charge a lot of rent. You've got to charge at least a 5 or 6% rental yield because the capital gains side of the picture is very difficult. Housing costs themselves are going through the roof, so you've got to hedge that, and getting finance is harder. So the numbers don't set up. Now, governments are aware of this and they're trying to do something about it. The thing is, the system moves so slowly because it's kind of like, Jim Chalmers comes out with a million new homes and wants to get a future fund done, can't get it through the Senate, so it gets delayed, and it gets to state government. We've just got new state governments in a couple of different states. They're planning, being reorganised. Then it gets to council, and council takes time as well. So even if, Jim Chalmers waves a magic wand on getting funding for this, it's going to take years for it to flow through the system. So I can't see a way around. Housing is just going to get tougher and tougher.
Yeah, abolish local councils. Let's bring that argument back, shall we? Anyway, I digress. Let's look at some of the winners and losers, though, especially in the small caps, because I guess there's been some sort of fairly interesting trends coming through there.
Yeah, I was just thinking, well, it's the penultimate day of the penultimate month of the financial year, so a couple of penultimates. But I was just kind of reflecting on May. And what's May told us, and we have had some hits and some misses, and it tends to be kind of sector-based. So, like, if you watch the market close enough or long enough, it does start to talk to you, and it's just giving us a little bit of a narrative. And one is just on retailing. So you mentioned Universal Stores, but there's a number of small cap retailers been absolutely smashed, and it's just this early sign of the cliff. So the people that are probably closest to the end of the cliff are younger people who are just in, a couple of years in the workforce, may have bought their first house, or they're feeling the pinch of rents, and they're the sort of sales that have really fallen off quickly. So that tells you it's going to continue to flow through. And so there's a bunch of small retailers that have done really, really poorly. The other side of the equation is builders. So, I mean, James Hardie is the 4th best performing stock this year in the ASX 100.
And your top tip,
My
lest we
top pick,
forget.
yeah, so far so good. Can we close the competition now?
Blow the siren.
I feel like I've got a neck in front with still a whole lap to go. But yeah, it's like the setup for building is really positive going forward, but the numbers are really terrible at the moment. So that's interesting how the market's sort of talking to us and saying we're looking across the valley in that area. The other thing is copper and gold. So copper and gold's been absolutely smashed this month. Copper in particular, everywhere you go, people say copper's fantastic. There's not enough of it. It's almost the best way to play the energy transformation, because it's not just in EVs, it's in poles and wires and all that stuff.
Everything, yeah.
And yet copper stocks have been absolutely belted this month. They're off about 10 or 15%. So it's just interesting, different winners and losers within the market.
Yeah, it's fascinating because you've got the bond market still indicating that at some point, we're going to see a pivot and they're going to, have to cut rates, particularly in the US. You've got longer dated assets really performing well, even if you take out all the AI hype. You know, before that really went full tilt with Nvidia, you'd already seen those stocks move off the October lows.
Yeah, absolutely.
And it just seems to me that there's lots of signals that the bond markets and even the share market is telling us that something major is going to break or something's going to happen that's going to cause the central banks to actually pivot. And that would be super bullish for gold, would it not?
Yeah, you would think so. I mean, gold's been a pretty strong performer just because it's been sort of risk off, and obviously things like the debt ceiling and stuff play to that narrative. But gold was over $2,050 an ounce. It's now sort of $1,950, so it's come off a little bit. You'd expect gold should do well going forward. However, I think the question you've got to ask yourself is, what does a central banker need to see physically, not think is going to happen, but need to see to get them to change the path of interest rates?
You better not answer that, because careful what we wish for.
That's right. The market's moving to a narrative that rates stay on hold. So they don't maybe hike them too much more from here, but we can start ruling out cuts. So you can see a real flattening of there's a bear flattening, is that what it's called? You're a fixed income guy, aren't you?
Oh no, I pretend to be, but go on, I'll try and think about it.
Bear flattening. So that's where, instead of pricing in rate cuts, the curve sort of flattens out, moves out. So that just means that the central banks are going to stay on hold for longer. That's also going to cause a lot of damage, right? Because we can probably put up with a year or two of high rates, and we just cut consumption and we all muddle through. We can't stand a long period of higher and higher rates. That's really going to hurt us a lot. So I think the question is, how much damage do they want to see in the economy in terms of household spending, definitely, but also employment. I, for one, don't want to see a fall in employment. I think that's terrible, because that's when things get really ugly. If they can manage this narrow path soft landing, where people pull their heads in, they stop spending money, inflation starts coming down a little bit, but we don't eat into the jobs story, that's a fantastic outcome for the market, because then we'll get lower rates and still a strong employment market, and that's a really positive setup for the equity market. So if that looks like it's happening, we're going to lean into equities at Shaw and Partners.
Well, we'll keep our fingers and toes crossed, because, narrow path, but one we all hope that the central bank has achieved.
Crossed.
Tight ropes.
Tight ropes indeed. Martin Crabb, Shaw and Partners, thank you so much for your time.
Thank you.
Always good to come.
Okay, well, let's push on and, how about we get to the leaders and laggards for the
Absolutely.
day? Waiting for that leaders and laggards graph to come up, if we may. I'll just see if we do have it there by any chance. Because, we do want to get across, obviously, who's
there we go.
and shaking. Leaders and laggards, there we go. And nickel mines up by 5.2%. We were talking about that one today. Did we find any stories behind
No,
it?
I didn't find anything in particular. We know Sandfire Resources, so some gold. We know Qantas had that update. Really interesting how they're talking about those super long haul flights are going to deliver so much in income.
I want to meet the
to that
psychos
company.
who are going to fly for 17 hours
I couldn't think of anything worse. 14 absolutely tips me
I have
over
a panic
into
attack, a bit of turbulence over Canberra between Melbourne and Sydney. What am I going to do over, the Middle East after 15 hours on a flight?
Sedatives, I think.
Yeah, maybe a bit of the old Valium. Anyway, that's Qantas is up by 2.5%. Challenger, we've already spoken about.
Yep.
We had a really great chat, or conversation was had there on the call today. Polynovo, that's just another one that moves around.
Absolutely.
A lot, really. I'm not too sure if there's anything behind that by any means. So the leaders there are, well, I suppose fairly diverse when you do look across the broad suite of the market. Real estate was, I think, a little soft today as well. We also had, energy looking fairly soggy. Telecommunications services, though,
they were stronger today.
The stronger area of the market, up by
Energy turned negative.
7%. Maybe we'll get to the laggards now, and there we go. Paladin. Well,
but in a trading suspension, so just bear that in mind.
Yeah, and you know what I was disappointed to see, well, because I own it, but IDP Education did not bounce back one iota.
Yes, it did.
1%.
No, I think you'll find it's actually more than that.
This one's for me, folks. What are we doing IDP
Yeah,
Education?
2.3%.
Well, I suppose from little things, big things grow, but that was pretty savage sell-off, I suppose.
It was, and I saw that State Street actually put in a sell notice, so they're no longer a major shareholder. That came through yesterday. Wow. But volumes were massive yesterday. It was over 240 million according to my sources, and about 77 today. Yeah. And I think volumes were pretty low. But look, the market's lackluster. People are going to want to see, I think, in the case of an IDP, that it's going to take time because they're really going to want to see what impact there is from.
Yeah, well, it could put the business back a fairly long way, right? If it's, I suppose, lose that sort of market share in that key market.
It's just the last of the monopolies that they held. So it's, it's part of a business evolving, and their businesses never continually hold monopolies. It's just how they adjust to it, the changes. Yeah. Okay. And that's where great companies do well. But Lifestyle Communities, I think they had an update and a bit of a miss there in terms of their earnings expectations or what the outlook is. And that's down 3.5%. And of course, the ever traded BrainChip Holdings are today down 4.4%.
Everyone's favourite ASX AI play. Get involved, I suppose, if you want to have a punt on that theme.
Yep.
General advice only. Okay, so there's your laggards there. Let's get across. Oh, we shrunk. Let's get across perhaps just the small caps, fittingly enough, as we shrink before your very eyes. And Berkeley and Energia, 23% higher. Wagner.
They had an upgrade, I think, to a speculative buy. We had that in broker call today, so up 15%.
Interesting. And let's get
vanadium, one of those special minerals for clean energy and strategic purposes. Yes, that was up 14.7. What about the laggards?
The laggards for the small caps today, nothing that jumps out there. Oh, Silk Laser, of course. Yep. And that was relevant today. It seems like there's not going to be such a standoff. Yeah. They back down. Yeah. When it comes to that sort of Silk Laser bit. Australia, was it pharmaceutical? What's the API? What are they called again?
Yeah, API, I think it's called. Wesfarmers.
Yeah, okay. Well, let's wrap things up, I think we
should.
But, at least we're going to have a lead to go off tomorrow morning. Danny, if you want to catch up on all the news and interviews today, including a lot of insight from the Stockbrokers Investment Advisors Association conference today, website and app, you know what to do. But otherwise, have a great night. See you tomorrow morning.
Bye.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.